Hey everyone, welcome back to AWM Insights. It's our last episode in the series we've been doing on building a sound human-centered investment portfolio. Hopefully it's been entertaining and informative, probably more so than entertaining. But without further ado, we're going to dig into the last topic here, which is really focusing on the building blocks, the how this all comes together, actual asset classes and specific assets in some cases that we pull together to build and construct this resilient, human-centered, purpose-driven investment portfolio that we've been talking about more kind of in concept over the last, 4 weeks now. We started off with why, talked a little bit about how from a high level, certainly hit on human-centered and why that is super, super important in our opinion. And then again, we're bringing it all together with the building blocks conversation here. And the first level of building blocks are asset classes. Why that matters, you can think about asset classes as your team roster. Certain players on that roster serve certain roles, offense, defense, special teams, etc. And when you bring this all together, you have this really robust portfolio that has growth and stability custom to your priorities, your human-centered nature, put together to manage risk and really accomplish long-term growth and ideally multi-generational wealth. So Mina, let's jump into it and give us the high-level definitions of these asset classes I keep talking about.
Yeah.
Here.
And the lay of the land, we'll start with cash because cash is the OG asset class. It is just fundamentally needed in everyone's portfolio. It doesn't make you a lot of money. It's not very interesting, but you need cash to pay your bills, to pay your mortgage. You're not going to pay American Express with, Apple stock or maybe a little parcel of land from your backyard. You need cash. So
hard cold cash. Cash is king, right?
Cash is king. That's really the starting spot that we should use. And then in terms of investable asset classes, there's fixed income. So fixed income is really the backbone of your portfolio. We talk about it all the time. It provides stability. It provides income, not flashy, but needed in market downturns like we saw 2 months ago. And it creates a bayou.
Right, and also known as bonds, or really these are just loans to someone else. It could be the federal government, it could be to the state government, it could be to Apple. Bonds are just loans in your portfolio.
Yeah, and then next we start getting into the more interesting asset classes, public equities or stocks. Those are the primary growth engine of the majority of people's portfolios, and there's a lot of different kinds. There's, U.S. stocks, international stocks, emerging market stocks, some real estate stocks, large and small companies. So there's a wide range, plethora of offerings. But yeah, those are generally more used for growth. And then
just to add, right, those stocks or equities, that's ownership in a company. It can be public or private. You're going to get into the private side of the world in a second, I imagine.
Yeah. Publicly traded companies are traded on exchanges, very liquid. You can buy and sell them easily. Private market assets and alternative assets just in general, harder to sell. They're less standardized, less commoditized. You can think about those as private real estate, private equity, venture capital, some of these just non-traditional investments a lot. And they differ from public stocks and public equities in the fact that they're not standard. It's harder to buy and sell them. And it does create, getting ahead of myself, but it creates a little bit more opportunity, I would say, for outsized returns. But that also comes with risk.
Yeah, that's good. We can leave a teaser out there. Okay, so I know for a decent number of you all, that was pretty basic, but we always like to start with first principles and make sure we're all on a level playing field. And so now that we have the common definitions down, let's get into bringing these all together, truly kind of the heart of this conversation today. One framework that I always like to say, maybe it's helpful for you, maybe it's not, is when we go to build an actual portfolio, one way to think about how we do that is is start with the foundation first, right? You can use an architecture analogy, or you could use, I often say Maslow's hierarchy of needs, or Maslow's hierarchy of portfolio needs, where we want the basic needs met first and foremost. And I mean, I'd love for you to walk through that thought process for everyone today around how we bring these together. What are the basic foundational assets that we use first and why, and then layer on risk, to your point, and take advantage of opportunities in other places.
Yeah. And I guess starting on the ground level in the hierarchy, we talked about cash. Cash is there, needs to be in your checking account. So when you swipe your card, it doesn't get declined. If you're using a checking account, if you write a check, again, does not get declined. It's there to meet your really short-term needs and cover your bases. But I would say there's also a psychological element to, logging in and knowing that you have multiple months of coverage is important. So that's also one thing that we help our clients with, is just making sure that they have enough cash, but not too much cash where it's a general drag on their portfolio. So that's the ground level. Moving up to the second floor, fixed income. We talked about how fixed income or bonds act as a defensive part of the portfolio. They dampen volatility. They're a little bit more predictable in terms of the income streams that they provide. I'll tease this out now, but fixed income is probably the most passive form of passive income. So there's that. And you get that just from the coupon and the interest payments, primarily from governments that you lend money to, municipalities like, cities, school district, corporations like Apple, Nvidia, when they issue bonds. So there's still risk in them. You can throttle up or down the risk that you want to take. That impacts the return, but ultimately these are safer assets. And if we do actually need to, replenish a client's portfolio, a client's cash portfolio, we typically do that with fixed income because it's pretty steady.
Right. In our portfolios, we're using fixed income as that true ballast. We're not taking a lot of risk there. We're matching fixed income with shorter term, super important priorities in a very kind of dollar for dollar manner, right?
Yeah. And it's really helpful because, like, if an unexpected priority comes up, you need to buy a new car, even though you lent money to the federal government, we're easily able to get that money back at a pretty stable value. And there's really no damage dealt, even if markets are not in a good place.
So once we have that foundational piece, cash, fixed income, really dialed in to meet short-term needs, what we call the protective reserve, liquidity, and spending potentially over the near term, where do we turn to next, and how are we scaling? I'm going to lead the witness here, but how are we scaling risk and potential return from there?
Yeah, and we're scaling it by time. If you don't need assets for multiple years, then we can use those and put them in the growth portion of your portfolio and create multiple drivers of growth that lead to hopefully excess returns over, longer periods of time. There's always going to be fluctuations in value, but the longer that you hold growth assets for, historically, the better that you'll do. So
the good old adage of compound interest being an incredibly powerful force.
Yeah, compound interest and patience and discipline definitely add and create a lot of value. So public equities, stocks, like we were talking about, that's really the most simple way of doing it. And the best way historically to actually take advantage of the stock market and public markets in general is to diversify. And that's diversifying across sectors. So you don't want, only to be investing in energy or tech. You want broad-based diversification. We've seen that, apparently and pretty profoundly since COVID. So yeah, that's one really core principle. And then you also want to be geographically diversified. We've seen that this year where you don't want all your public market portfolio to be in US markets. You need international diversification. And this year, if you were not internationally diversified, you were hurt by that. So international and geographical diversification, super important. And then there's also diversification in different size of companies. A lot of people look at the S&P 500 and think there's only 500 companies that you should buy and you should only focus on the big names. That historically has not been true. So diversifying and owning as much of the global economy as possible is really the most effective way in playing the game of the public markets.
Right. And it's important to hit on this idea that's the most important way to play it in the highest probability or most confident manner, right? We want to do things with confidence in mind, with confidence in expected returns that support the human and the human's priorities.
Yeah, absolutely. And then if we shift to real estate, there's both public and private real estate. And real estate's interesting in that it provides a blend of income and capital appreciation. It also provides inflation protection and some tax advantages. So you can access that either publicly or privately. Our methodology, as you guys can all guess, is you need a diverse blend of both. Can't really just focus on one area. You can't be under-diversified, overly concentrated into a single property, single market, single type of real estate. There has to be broad level diversification because there are risk factors that are unique to real estate: leverage, illiquidity, concentration. If you have too much real estate in Florida and a hurricane comes through, that can impair your portfolio forever. So we definitely don't want to do that. And then moving on to the last real main asset class, private markets. Private equity and venture capital are the markets that we really focus on. Those offer a different set of diversification benefits. You're owning smaller companies from a relative standpoint to the public markets, and you're typically getting into them at advantageous times if you're investing with the right private market manager. So that creates, I would say, an interesting component to the team. And you can think about it as having like a great special teams unit, like a great kicker, great punt returner, great kickoff returner. They can really add significant value to your team over long periods of time. And if you don't do it well, it could be an absolute disaster. So making sure that side of the ball is dialed in is super important as well.
Yeah. No, you're going to let it get to Jeff's head there. So, all right, that's super helpful. And kind of as we start to bring this to a conclusion, land this plane here, one thing we want to hit on briefly is how we go about selecting the actual assets that fulfill these asset classes that we've talked about. One key principle we've hit on, it's an analogy that I love, is we think about really trying to be the casino. Right? Where can we stack? I said it earlier. Where can we stack the odds in our favor, the probabilities of success in our favor, where we're operating with a much higher level of confidence, so our clients, you all, can meet your actual goals and priorities. That is the standard in which we set ourselves to. We don't want to show up at the casino and be the gambler and play this game and this game and this game and just kind of chase our tail, play whack-a-mole, and then end up with nothing. Right? Those are the extremes of this. And so as we think about the characteristics that we look for, it's really data-driven, academic leaning in nature. What does the data say? Where can we see data telling us a really, really, really strong story? Thinking about costs, whether they be actual management costs or taxes. We want efficiency there because any cost from the portfolio is not ending up in our clients' pockets. And then where can we take more risk or less risk and different types of risk? So you talked about the private markets, right? The manager there matters a ton. And that's a risk we're calculating and deciding to take. Whereas in the public markets, you don't really want to put risk in somebody's ability to pick stocks. It just doesn't make sense there. And then, of course, diversification, systematic rebalancing, bringing it all together into a customized portfolio that has a risk managed approach tailored to you specifically and your priorities and your human-centered nature. So hopefully this series overall was super helpful for everyone and gives you a pretty good glimpse into what it takes to build a sound investment portfolio and most importantly, kind of the human-centered sound investment portfolio. We really view investing and wealth, the best way to manage wealth to be done through a purpose-driven lens in a disciplined, long-term fashion. That will drive multi-generational wealth. That will drive comfort and hopefully understanding and the ability to sleep at night. And really at the end of the day, hopefully just a better understanding of all that goes into this overall process. So I'm going to wrap there. Hopefully, again, it was helpful. If you guys have questions, definitely reach out. And we will continue insights beyond this and back to kind of our regularly scheduled program. But until then, own your wealth, make an impact, and always be a pro.